In this module, we're going to talk about 5-wave trends and identifying if a market is in a 5-wave trend and then if it's completed a 5-wave trend. Well, once a 5-wave trend is complete, what should we anticipate? Well, the minimum expectation is a correction greater in time and price than any correction within the 5-wave trend. So that's a significant piece of information itself. And we're going to begin this chapter, this section slowly, identifying 5 waves, identifying what is likely to occur once the 5 waves is complete, identifying when it's complete, all those sorts of things. So we'll do it step by step. But for right now, the simple reason that we want to identify if a 5-wave impulse trend is complete is that it's usually followed by a correction greater in time and price than any correction within the 5 waves. It's possible it would be followed by a major trend in the opposite direction. That's going to depend on where within the higher time frame trend, the larger degree trend, however we want to call it, that particular 5-wave section was made. We'll learn about that in our subdivisions section, where we look at higher time frames and lower time frames, etc. But for now, what would indicate that a 5-wave section is complete? So we've got this data on this chart, and this is Apple daily data, and I've labeled it 1, 2, then we had another significant advance, 3, 4, and then another advance to a new extreme. I've got a question mark on it. We don't know if that wave 5 is complete or not. But what would indicate that it's complete? Well, certainly simply a decline below the last swing low, which I've got labeled as a wave 4, would indicate waves 1 through 5 is complete. And that trend, that impulse trend, is complete. And when we have that signal, we should anticipate at a minimum that a correction greater in time and price than any within the 5 waves would be complete. And that would be the wave 2 or the wave 4. So what I usually do is if I suspect that the market's in a position to complete a wave 5 and a 5-wave trend, is I just draw a line, a horizontal line across the last swing low, which should be a wave 4 low, and I make it a price alert. And then as data is added on, as days continue on, depending on the time frame we're looking at, when we take out that low, we call that a pattern reversal signal. You'll learn a lot more about those later in this chapter and as well as within the course within trading strategies. Well, that indicates that this 5-wave advance is complete, and at least the least expectation we should have is then a correction greater in time and price than any within the 5-wave trend. So I'm going to add some data on here. And there we are as of, actually I got moving a little too fast there, but as of that last bar in the chart, we've declined below what I had labeled as a wave 4. This 5-wave advance should be complete. The minimum expectation is a correction greater in time and price than any within the 5 waves. And it could have other ramifications besides that, but we're going to keep it simple right now. So another characteristic about 5-wave sections is that they should be in the direction of the higher time frame or the larger degree trend. Now we're going to learn a lot more about that in other modules, but I want to plant that seed that 5-wave sections or 5-wave impulse trends are usually in the direction of a much higher time frame trend. In other words, they're only one section of the higher time frame. There's certain circumstances where they may be the final section, and also they may be the beginning section or the beginning sequence. We'll learn more about that later on also. But it's just really important to identify if it's a 5-wave section, if it's part of an impulse trend, and where we are within that trend. There's a lot of information you're going to be able to gather from the potential position of the market within a 5-wave trend. So if I add more data on here, we can see At least as of the last bar, we've already made a correction greater in time and price than any correction within this 5-wave trend. So you'll learn other strategies further on in this course to identify when and if a correction may be complete. I'm just adding some more data onto here. So as of the last bar in this chart, that's actually around the day I'm recording this, is that we've already had a significant correction. What does this look like, by the way? That looks like a beautiful 5-wave decline, doesn't it? Well, you'll learn the ramifications of that later on when we talk about subdivisions and corrections and different degrees. But that's meaningful. So the market is always giving you meaningful information. Let's continue on and learn more about the rules and guidelines of 5-wave impulse trends. There's just 3 rules for a 5-wave trend. Pretty simple, easy to identify as a market unfolds and bars are added on to the market. So let's take a look at those 3 rules, then we'll look at them more in depth. So I'm going to use the same example we used earlier with Apple and this trend coming up. This is already, now we already know that it's a 5-wave trend. It's already complete, but we'll show it, we'll use it to demonstrate the rules, and then we'll look at a number of other situations as the bars are being added on bar by bar to see if the market conforms to the rules. So from this low, which was back in September, we had an advance and then we had a decline. So our first rule is that the wave 2 cannot exceed the beginning of the wave 1. So that's a pretty simple rule and pretty obvious rule, logical rule, is that if we have a section up, which we're calling a wave 1, and then we have a correction down, which would be the wave 2, is that it has to remain above the swing low that began the wave 1. In other words, if we're looking at a bullish 5-wave impulse trend, we need to make higher highs and higher lows. We can't take out a prior low and say that we're having an impulse trend. So that's a pretty simple rule. And rule number 2 is that the wave 4, again, wave 4 is a correction, cannot make a daily close in the closing range of the wave 1. And so I've drawn a horizontal line from the closing range of the closing high of the wave 1, and we can't close below that level. In this case, it's 124.40 for this to be considered a wave 4. Now, in traditional academic Elliott wave, you can't trade into the range of the wave 1. So I found after 35 years of trading and studying and applying Elliott wave that it's much better if you use a close into the closing range of the wave 1 instead of simply a trade into the range. This is particularly true with leveraged markets such as the futures markets. And now that we have 24 hours markets, which we've had for many years, is that many times we'll see a wave 4 will trade into that range of the wave 1 and then just turn around and continue to a new extreme. But the closes are important. As long as it hasn't closed into the closing range of the wave 1, it can be considered a wave 4. And so what I do is I just draw a horizontal line from the closing high of what I believe is a wave 1. And if I believe we're in making a wave 4 correction, as long as we haven't closed below the closing high of the wave 1, if we're in a bull trend, it is in a position to be a wave 4. And notice my language. I always say, is the market in a position to be such and such? I'm not making a statement that this is a 1 and this is a 2 and this is a 3 and this is a 4, but they're in positions, these sections, to be waves or sections 1, 2, 3, and 4. We may find out as more data is added they're probably something else, or they could be something else, but they're in a position to be waves 1 through 4, as long as we don't close below 124.40. Okay, the third rule is that the wave 3 cannot be the shortest in price range of waves 1, 3, and 5. So we have the impulse sections, which is a 1, a 3, and a 5. We can also call them the trend sections. Those are the sections in the direction of the higher time frame trend, and the direction of this 5-wave trend is that the wave 3 can't be the shortest of 1, 3, or 5. And we'll see later on how valuable that piece of information can be as well when we identify some time and price targets. So for instance, in this, what we're looking at here in this potential 5-wave section, is it's pretty obvious that the wave 3 is considerably greater than the wave 1 or the wave 5. So what I usually do is I always mark my swing highs and lows, my potential section highs and lows with the price in the price range. So this section up was 22.29 points. What I've got labeled the wave 3 was 31, so it's obviously greater than the wave 1, so that means it's not going to be the shortest of 1, 3, and 5, no matter what 5 turns out to be. And of course on 5, at least as of the last bar in the chart, we don't know if it's finished, but it's 18.15. So 3 simple rules, easy to identify, but very powerful when we're identifying potential wave counts and sections within a trend. Okay, let's take a look at some more examples and the rules one by one. Well, rule number 1 of a 5-wave trend is that the wave 2 cannot trade beyond the beginning of the wave 1. This is probably the most simple rule, and just, well, of course, they're all pretty logical rules, but this is so simple that if we believe a new trend is beginning, in this case a bull trend, then of course it should make higher highs and higher lows. Higher swing highs, higher swing lows, sections, whatever we want to call them. So if we believe that from May 31st, and this happens to be 2019, a year or so ago, we were beginning a new bull trend, new 5-wave bull trend, and if we believe this initial advance was a wave 1, let's put the 1 up there. I'll almost always put question marks by my labels until it's been confirmed that it's either that or something else. So if we believe this is a wave 1, well, what can wave 2 not do? Well, the obvious thing is it can't trade below the beginning of the wave 1, wave 1 extreme, in other words. So what I usually do is I use a lot of price alerts and just horizontal visual lines. I use a stop outline, let's call it. It's usually thick and red. So in this case, I've got the horizontal line on the beginning of what was potentially wave 1, and you just make a price alert out of it, and if it trades below it, then, well, this can't be a 1 and it can't be a 2. I mean, that's just the rule. So we'll add some data, getting pretty close to that line, and there we went below it. So regardless of what else we thought pattern-wise was going on in the higher time frame or whatever, is that the one thing this can't be a wave 1, and this can't be a wave 2. Something else is going on. So we can call this a pattern reversal signal in that this trend is not beginning a bullish impulse trend. Something else is going on. We've voided that potential. So you might say, well, that's pretty simple. What does it tell me? I mean, does it really give me any additional information? Well, it gives you some additional information depending on what your technical position or pattern position or whatever it was, where you believed that the wave 1 began. Because this is voiding that whole idea that we're beginning a bullish trend, so it could be something dramatically different. So if we had a confidence enough to believe that there was the beginning of a new 5-wave bullish impulse trend, and then the market voided that by trading below what we were assuming was the beginning of wave 1, well, then we've got to take another close look at this. Axioms of trading is that when a market doesn't do what it's supposed to do, frequently it does just the opposite in a dramatic fashion. So potentially we would want to take a double look at our technical analysis and our pattern position, in that this market may be exceptionally bearish. I'm not saying that it is. It's not a forecast. This is a piece of information that can be valuable. Rule number 2 for 5-wave trends is that the wave 4 cannot make a daily close into the closing range of the wave 1. And once again, the rule from academic Elliott wave analysts is that wave 4 cannot trade into the range of the wave 1. I just found so many times over the years, particularly since we've had the 24-hour trading, is that frequently a market will trade a few ticks into the range of the wave 1 and then continue the trend strongly and into a typical kind of impulsive 5-wave trend. So I developed some years ago that had to make a close, a daily close, into the closing range of the wave 1 to void it being a 5-wave trend. So that's my rule number 2. Well, I think you'll find, like I did, that this is a very useful alteration, let's say, of the traditional academic rule about the overlap from waves 4 and wave 1. So let's take a look at the data on this chart. So as of the last bar in the chart, we've had a substantial decline, then we had a correction, and then a continuation of the decline. So we're looking at a bear trend this time. And of course, all of the rules, all of the patterns, everything applies for bull trends and bear trends equally. So if this market is making a bear trend, an impulsive bear trend, and it's in a position to be in a wave 3, what can this market not do? Well, it cannot make a correction and make a close into the closing range of the wave 1. Because a correction, once we're in a position to be in a wave 3, a correction would be a wave 4, and a wave 4 can't close into the closing range of the wave 1. So what I'm going to do, I'm going to draw a horizontal line from the closing low of wave 1. And so I hit my C key and my software, whatever software you're using, you should be able to display a close-only chart. And we see that the low close of what I had labeled as a wave 1 is at this level. This is the euro dollar, by the way. Once again, everything we learned is applicable to Forex and stocks and ETFs and futures, you name it. So we simply draw that line along the low close, and as usual, I make it thick. In this case, the color I'm going to make it as green, because if we close above that level, then this should not be a wave 3. It's probably not an impulsive decline. We'll learn more about what I call this the closing overlap also in the section on corrections. But for right now, we make that little price alert, and if we happen to close above that level, then this cannot be a wave 3. Something else is going on. So let's add some data. There we go. As of the last bar on the chart, the decline did not continue, the bear trend did not continue, and we closed into the closing range of the wave 1. So this cannot be a wave 3. It has to be something else. Now, when we get into subdivisions and some other details, we'll see that this possibly could still be a bear trend. This could be what we call a 1-2, and then a 1-2 of 3. But as you also see, very unlikely. More than likely, we're not making an impulsive bear trend. More than likely, We're making some kind of corrective decline and not an impulsive bear trend. So for now, though, we can say this can't be a wave 3. Something else is going on here because we've just violated rule number 2 that wave 4 can't close into the closing range of wave 1. So it's really good as a market unfolds, you kind of constantly ask yourself the question, what can the market do to confirm the position I believe it's in? What can the market do to invalidate the position I believe that it's in? So in this case, it invalidated this as a potential wave 3. Rule number 3 of a 5-wave impulse trend is that wave 3 cannot be the shortest of waves 1, 3, or 5. Well, we have some daily data of the ES on this chart. And let's take a look at this rule and how we'd use it. As of the last bar in the chart, we have a potential 3 waves up. Wave 3, I have a question mark by. It hadn't been proven out yet. But let's assume that we believe we've completed a wave 1, a wave 2, and a wave 3. Now we can kind of look at this and the ranges of the wave 1 and the wave 3. We can see that wave 3 is shorter than wave 1. And I have the markers up here is that wave 1 was 791 points, wave 3 was 471 points, so obviously it's less. So we have a couple things we want to look at as we add bars on here. And number 1, of course, is the wave 4 can't close into the closing range of the wave 1. And once we believe the wave 4 is complete and the wave 5 is underway, is because we already see that wave 3, as labeled here anyway, is shorter than the wave 1. That means the wave 5 cannot be longer than the wave 3, because that would make wave 3 the shortest of 1, 3, and 5. So let's add some data onto this chart and see how things unfold and what information it gives us as we add the data. And before we get started, I'm going to draw the horizontal line across the close of the wave 1 high. And I'm going to go ahead and do what I usually do. I usually color lines like so. There we go. So number 1, if we believe this is a wave 3, the market, this market, the ES, cannot make a close below 29.41 because that would be a close into the closing range of wave 1. So we want to have that on our chart. Okay, I'm going to add some bars onto this chart. So here we can see an example of where it traded into the range of what I got labeled a wave 1, which would void this as a wave 4. But our rule is, and trust me, this rule will be very, very helpful in the years to come for you, is that a wave 4 cannot close into the closing range of wave 1. Let's add some more data, keep adding. There we go. Looks like we've advanced above the wave 3 high. I could have drawn a line in there, horizontal line, and set a price alert to let me know when it was above it. But let's, for now, let's take that question mark off. So let me label this low, and we'll just call that a potential wave 4 low. So I had taken the question mark off here. I guess we should still leave leave these on. We don't want that. Excuse me. There we go. So these are still questionable. So what can the market not do if this is a 3 and this is a 4? Well, the range of 5 cannot be greater than the range of 3, because we've already seen that the range of 3 is less than the range of 1, and 3 can't be the less of 1, 3, or 5. So what we usually do, we'll get into a lot more of this later on, and price targets and price relationships, that sort of thing, is let's just make this simple, and we'll do the 100% alternate price projection, and that of the range of wave 3. So that'll give us the upper limits of what the wave 5 should be. Let me scroll down here. I'll make that thick. So what I've done is that I've measured the range of the wave 3, because it's already the shortest, that's 471 points. I've added it on to the potential wave 4 low. And if we're making a wave 5, it cannot exceed 3394.75, because if it did, then the wave 5 would be greater than the wave 3, and the wave 1 is already greater than wave 3. So something else is going on. So let's just add some data here. Let me move that out of the way. Look how it just hung in to that 100% alternate price projection, which is the maximum possible for a wave 5. Well, we've added more data, it's exceeded it. And as of the last bar on that chart, at least, let me square up the chart for you here. As of the last bar on the chart, the advance off what I've got labeled a wave 4 low is greater than what I got labeled a wave 3. And so this can't be a 3 and a 4, and it's making a 5. Something else is going on here. So we can't consider this waves 1, 2, 3, 4, 5. It's something else. So when we get into subdivisions and that sort of thing, we'll take a look at the alternatives that it may be. But the one thing we know, this is not a wave 4, and this is not a wave 5. Let's take a look at a couple examples, bar by bar, to see how we make decisions about what the pattern may or may not be, what would confirm or invalidate a particular pattern. So as of the last bar on this chart, which is the British pound, daily data, as of the last bar of this chart, we've had an advance, we've had a decline, a correction, and then we've had another advance to a new high. So let's assume our other technical analysis or higher time frame pattern, we believe that we're in the beginnings of a bullish, impulsive 5-wave trend. We don't know that for sure, but that's why we're going to look at each bar as it's added onto the chart to see what would confirm or what would invalidate the continuation of the bull trend. So this is a potential 1, potential 2. Notice that I say potential. I really should have question marks on all of these. Oh, excuse me. There we go. Until they're confirmed, that's what I typically do, is put a question mark, then once it's confirmed, we can take it off. Was a probable 1 or probable 2 in the beginning of a new impulsive bull trend. We've gone to a new high. Let's add a couple bars on to this data. And we have a significant advance, making higher highs every day. So if this is a 1 or a 2, and if this market is making a 3, what should it not do if this advance is a 3? Well, it shouldn't close into the closing range of the wave 1. So let me take that off. I had that swing high on. I would have had an alert on that in the event of a trade above that level. Would confirm that the correction was over. I'll take that off. Let's find out where's the close of the wave 1. Is that the close of the wave 1? Well, let's take a look. It's the high close before we had this correction, so good enough. Let's make that thick. I'm going to color it red because if we close below it, that indicates that we're not in a wave 3. Something else is going on. So we're going to make that an alert. There we go. So let's add some more data and see what happens as we add data. continue to advance pretty strong. This itself is a strong impulsive trend. We'll get more into the subdivisions and how the sections within a trend break down in another module. I'll keep adding data. So here's a good lesson so far. Number one is we've had our probable 1, probable 2, had a considerable advance, probable 3. I'm going to take these guys off for now. Probable wave 3. What's happened here so far? Well, so far, this is pretty much sideways. You'll learn more about corrections later. Looks kind of like what we'd call an ABC flat correction. It's not finished, whatever is happening here, but some sort of sideways movement, some sort of correction. It's a correction greater in time or price than any since this low. So depending on where we start, if we start from here, we've got about 6 or 7 days, essentially net sideways. Even if we begin from this, that looks like it's a little higher close anyway, at least 3 days sideways, similar to this correction, 3-day correction. So the point is, we're probably correcting this part of the advance. In other words, a correction to the wave 3, which should be a wave 4. Let's add some more data. So as of this point in time, we've been sideways. It looks like about 6, 8, maybe 10 bars even. The point is, if this is a 1, this is a 2, this should be a 3, this should be a 4. Where is the exact high of the wave 3? Is it here? Is it here? For our purposes, it's not particularly relevant. What's important, and I'll just put it here, is that we've had an advance, we've had a correction, we've had an advance to a new high and a significant trend up, and then we've had a correction greater in time and price than any since this section began. So it should be a higher time frame correction, meaning it should be a wave 4, and we've gone to a new high. So we can go ahead and label this a wave 4. Let's add some more data onto the chart. Now that we made the new high, there's this potential that if this is a 4, then we're in a wave 5. What would signal that a wave 5 is complete? Well, certainly a trade below the wave 4 low. So we can put a low here. We're just looking at this real logical. We made the new high. We've got a 1, 2, 3, and a 4 sections up, and we're in the 5th section. So we're in a position to complete this 5-wave advance, and a trade below the wave 4 low would indicate that this structure, this impulsive 5-wave advance, is complete. So let me add some more data. Well, we're all over the place here. Continue to add some data. Oh, we made a new extreme here. So is this a wave 4 or is this a wave 4? I don't know. Right now, does it really matter? It's a corrective low. So maybe this is part of the wave 4. Maybe this is the 4. Maybe, we would look at this as the 3 and a 4, or something along those lines. What's important here is not to get paralysis of analysis, but to understand we've got a section up, a correction, another section up, a correction larger in time and price than anything since the last swing low, which we've got labeled a wave 2. So somewhere in here is a wave 4. We've gone to a new extreme. Again, we're in a position to complete a wave 5, and the pattern reversal signal, which you'll learn a lot more about later in the course, would be a decline below that swing low. So we don't need the paralysis of analysis of exactly where is the 3 and where is the 4. We just need to know that we're in a position to have completed 3 and completed 4, and 5 is underway, and we've identified what the market can do to indicate the 5 is complete. And of course, later in the course, you're going to learn about how we can bring this reversal signal up much closer to the market. But let's just add some data. Well, there we go, a decline below that low, what I've got labeled the wave 4 low. So at this point in time, let me add this label on. We have 5 distinct sections. We've declined below the last swing low. This 5-wave advance is complete. So we're either beginning a correction against this 5-wave advance or a new bear trend. Again, we'll get into that when we look at subdivisions, higher time frame, lower time frame, multiple time frame views of the market. What's important now is you learn how to think. You learn how to make decisions bar by bar about what is the probable position of the market, what confirms a trend or a counter trend, and what invalidates the structure as a trend or counter trend. Let's assume, as of the low bar in this chart, that we believe, this is the stock of Tesla, by the way, it's the daily data. We believe that Tesla is in a position to have another strong bull trend to new highs. Now, we don't know if that's for sure. We're not forecasting it. But let's just say, given the higher time frame data, the other technical positions of the market, the pattern position going into this low, that we believe that that completed a correction and we're going to continue a bull trend, and we should have another bullish sequence to new highs, to new extremes. So let's follow along once again, bar by bar, to see how we confirm or invalidate that idea. As of the last bar in the chart, we've had a section up, so about 5 or 6 days, and then kind of a steep correction here. This is only a couple days. So let's just say this is a potential one, and I'm not going to put the question marks on it right now, and we're making a 2. But, of course, they're questionable. They haven't been confirmed by any means. But let's add some data. And what can the market do to indicate that we've completed this section, we've completed a correction, and then we're making another section up to a new high? Well, of course, just take out the swing high. So let's add some data. And, of course, I should have said by declining below the beginning of this first section up, that would, of course, void it as a 1 and this as a 2, because a wave 2 can't trade beyond the beginning of the wave 1. Okay, here's the last data on the chart. And not a really bullish day. We certainly traded above this wave 1 high, but then we came down and closed in the lower half of the day, kind of the lower 1/3 of the day. So we didn't close above this high. Maybe we closed above the closing high. I guess the point is that I'd like to see another day where we get above that high before we even consider that we're in a bull trend. Well, there we go. Now we've cleared this high for sure, and we can say this is a probable 1, probable 2. We're probably in wave 3 here. So before we continue and add more bars, is this the corrective low, or is this the corrective low? If we look at the close-only data, the closes here are actually lower than the close back here. So what I usually do, when it looks like we've got just one volatile kind of bar that made an extreme and came back, in fact, even on this day, it didn't close near the low, it closed in the upper part of the range, and then we're sideways for another 4 or 5 days, I'm probably going to be looking at the corrective low. The end of the correction is a better way to put it, not necessarily the corrective low, but the end of the correction on the final bar before a resumption of the trend. And once again, we'll get into more of this when we do subdivisions. Right now, I want you to just kind of think logically. So it looks like we had a section up, then we're down to sideways before we began the next section up. So section up, correction, continued section up. And again, I frequently look at closes when I've got some volatile day that really doesn't fit in with what's going on. Maybe that was a news day or something along those lines. But here's the end of this correction. So let's add some more data. what are we looking for? We've had a significant advance compared to this advance, so I would say we can pretty much confirm that we've completed a 1 or 2, and this is indeed a wave 3. If we're going to consider it a wave 3, what should the market not do? Well, we always want to identify that, and it should not close below the closing high of the wave 1. So we always put that in automatically. So the other thing we're going to be looking at is if this is a 1, if this is a 2, we're going to be looking for a correction greater in time and our price than with this wave 2 correction. Now, we're getting to significantly higher price levels. So the first thing we're going to look at is a correction greater in time. So in this case, 1, 2, 3, 4 or 5 days. Let's just say 5 days. There we go. So our correction, what we got labeled a wave 2, is like 5 trading days, around 10%. Depends on which low that we use here, but close enough. So we're looking at around 10%. The reason I'm looking at percentage here is the higher we get. This correction was $48, but as we get in higher levels, a $48 correction is going to be a very small percentage amount. So frequently, for the more major moves, I look at percentage change as opposed to the actual range of the price. So we'll talk about that more when we see other examples as we go through the course. But for now, we're looking for at least a 5-day correction. And if we get around a 5-day correction, then that should be of the same degree as this correction, meaning a wave 4. So let's just keep adding data and think about what's going on here. Boy, a big, what we call this is a big outside bear reversal day. It's actually what we call a 2-close reversal. In one day, it made a new high, then came down and closed below the closes of the last 2 closes. Are we beginning, have we completed a wave 3 high? Are we beginning a wave 4? We don't know yet. We got to add more data. So we just had a 2-day decline. Very minimal decline. Lesser degree than this, so more than likely it's just a minor correction within this advance. It's not the quote-unquote wave 4 that we're looking for. There again we go. And a 2-day decline. So again, boy, in time-wise, it's not of the same degree as what I got labeled as a wave 2, another 2-day decline. These are just little small 2-day declines. Boy, this market, Tesla is on a tear during this time period. We'll add some more data. Oh, here we go. So as of the last bar on the chart, we've had the advance off of this low where it went to the new high, probable 1, probable 2. We've just had these little 1- and 2-day declines, corrections. And so they're not of the same degree as this 5-day. We can either just kind of look at the chart and go 1, 2. These are of a different degree. These are just little minor corrections within this section up from the wave 2 until we get to this point in time. And we've been sideways for 6 or 7 days, it looks like. So I'm going to consider that this is probably a 3, and we're probably making a wave 4 correction. Now, you'll learn a lot more about corrections in the next module. However, this is what we probably call A, B, C, D, E, something along those. It's a contracting triangle. There's a lot of names that have been given to it, whether you're looking at it from an Elliott wave standpoint or a traditional charting standpoint. But the point is, it's higher degree than either of these, any of these, and it's similar to what we got labeled a wave 2. Probably make it a 3 and a 4. Let me just add some more data. As of the last bar in the chart, we've gone up. We've made a new high, a new extreme. We now have a probable 1, 2, 3, and 4. And so we should be, if this is a 1, 2, 3, and 4, then the market is in a position to be in a wave 5. And if there's any decline below this wave 4 extreme, it would indicate that the bull trend up from this low is complete. It's completed a 5-wave trend. So boy, we have some real important piece of information here, recognizing that we're in the fifth section, or I should say we're probably in the fifth section of the advance from the low several weeks before. It looks like at least a couple months before. This was in October. We're already into January. And that's an important piece of information. If we should take out that low, then it would complete this 5-wave advance. Well, let's continue to add some data. So as of the last bar in the chart, more than likely, Tesla has completed a 5-wave trend, a 5-wave advance into a new high, and it's going to have a correction greater in time and price than any correction within this 5-wave advance. And of course, those corrections were pretty small. Just 5 days, this is about 2 weeks sideways or so, but it's still a valuable piece of information to have. Now, we didn't close below the closing lows here. We just traded below it. So we have traded below it. What I would say at this point in time is say, I want to see a lower close. I want to see the market get below or close below the lowest close of this, what I've got labeled a wave 4, that contracting triangle, or whatever we're going to call it. Draw the line across here. I'm going to make it thick because it's a close. Going to make it red. So this isn't a rule. Let's call this a guideline of when it's kind of iffy. We only advanced for like a day above this high. If we want to consider all of this the wave 4 low, yes, we've traded below it. Let's close below the low close of this potential wave 4, and that would be in that area there. That's just kind of logical. It says, okay, that confirms that we've completed that top. So, well, there we are. 1 day later, we closed below it. So now we can look at this as a 1 through 5, and we should have a decline greater in time and price than anything since this October low. Now, how does this 5-wave advance fit into the larger time frame? What came before? What may come afterwards? Well, that depends on where within the higher time frame trend this 5-wave advance is. Remember, when we began this example, is we just assumed that this low, in this case it's October 30th, we assumed that that completed a higher time frame low, and we were beginning another 5-wave advance off of that low. We didn't look at the larger time frame. We didn't look at the data before it. So how it fits in, that's for another lesson. But right now, we've probably completed this, and we're going to have a fairly substantial correction. So that's exactly what unfolded. So once again, a lesson here is, as we add each bar in the chart, how does it fit in logically with the potential structure of the chart? And kind of a lesson here is, as a market advances, in this case, in a bull trend, and we have, these are kind of fairly substantial corrections. Not in time, they're only 2 or 3 days, but in price percentage we'd find that they're reasonable corrections. But what we identified is they were probably of a lesser degree correction than this 5-day 10% plus correction, because these were only 2, in one case 3 days. We needed to see a correction that was of similar degree to this 5-day 10% correction, and it wasn't until we got into this it's probably a 7-8 day or more, maybe even a 10-day sideways correction, that we could say that was making a correction of similar degree to this wave 2. This is the euro dollar versus the US dollar, and it's 240-minute data. Let's assume from the high in this chart, this section right here, we believe that the bear trend has continued, and we want to look at the data, the 240-minute data, to determine if it's making an impulse trend, and if it is, when will it be in a position to complete that impulse trend? The practical application of this is, for in the early stages of that bearish impulse trend, we'd want to know that, and we'd either want to orient our trades to the short side, or if we have to be long, depending on our trading time frame, we might want to bring our stop very close to the market in the event we have a larger time frame decline. So let's look at the data as of the high on this chart. We've got one obvious swing down, section down, which made it at least a slight new low. Then we had a correction greater in time and price than any correction since that high. And then we continued down to a new extreme. So we can look at this as a potential 1 and a potential 2, and that we're making a wave 3. Well, if this is a wave 3, and we believe it's fairly far along, we've gone below this low by a good amount, what should the market not do if it's making a corrective rally and a wave 4 corrective rally? Well, in daily data, it shouldn't close into the closing range of wave 1. Now, this is intraday 240-minute data. So this is really just 2 days of data, about a 1-day correction, and then we're in the second day of a decline. So closes on intraday data are meaningless. It's just an arbitrary point in time. So a close into the closing range of intraday data is not significant. So in this case, we revert to the, when we're using the intraday data, we really revert to the academic or more typical Elliott wave rule that the wave 4 should not trade into the range of the wave 1. So if that's the case, let's just draw a line across the probable wave 1 low. I'm going to make it thick. I'm going to make it green, because if we trade above this level, then this is probably not a 1 and a 2, and it's probably not making a 3. Something else is going on. So we make that an alert, and let's just add some bars onto the chart. Well, we continue quite a bit lower. So our assumption is we're making a wave 3, and we certainly should not trade into the range of the wave 1. We'll add some more bars. Well, as of the last bar in the chart, what's going on here? Well, if this is a 1 and if this is a 2, how many bars was that? Let's just get an estimate here. It was 5 bars, certainly a greater correction in time and price than any since what we're calling the wave 1 began, probably a wave 2. Our wave 4 should be similar or greater to time and our price than the wave 2. So we've probably got a good at least 5 days here. Or excuse me, 5 bars here. It's exactly 5. So this is in a position to complete a wave 4, or to be a wave 4. Let's add some more bars on the chart. Well, this is definitely a correction greater in time and price than any correction since this potential wave 3 began. So more than likely, it's a higher time frame correction than any within this potential wave 3, this decline. So what should that be? Well, more than likely, this is a 3 and this is a 4. So let's add or label these as a probable wave 3, probable wave 4. If that's the case, we're in a position for this to be a wave 5. What would indicate that the wave 5 is complete? Well, certainly a trade beyond the extreme of the wave 4. And once again, as we continue in this module and we go through the chapter or the module that's on subdivisions, we'll be able to identify a market action much closer than this wave 4 extreme that'll indicate that this wave 5 is complete. But for now, let's just add some data and look at this logically on what will confirm or invalidate this is a probable wave 5. So I'll add some bars on. This potential wave 5 continues lower and lower. And then we've made some kind of reversal here. So we'll continue to add some more bars as we exceed the wave 4 extreme, what we've labeled a wave 4 extreme. Then this entire decline, this 5-section impulse trend, bearish trend coming down from the high that's shown on the chart, should be complete. Now, what does that mean for the larger time frame? Well, again, it depends on how this fits in to what came before and what may come after. That's for another lesson. Let's continue to add some bars. And there we go. As of the last bar in the chart, we have to consider that waves 1 through 5 are complete. And this section, this 5-wave bearish impulse, is complete. And what that means for the larger time frame trend will be dependent on how it fits in with the larger time frame trend. But we can see how even when we get down to intraday data, whether it's a bull or a bear trend, these patterns are extremely useful. Well, let's review the rules and the guidelines for a simple ABC correction that we also call a zigzag correction. It's the most frequent type of correction that we find in all markets and all time frames, and it's the simple ABC. The first rule is the wave B should not exceed the beginning of the wave A. So let's take a look at this data we have so far. We have this bullish trend up here. We've got a decline that's greater in time and price than any of the declines during this bull trend. So it's potentially beginning a correction against this trend. We'll just assume that's the case. So we have this decline, then we have a little advance, and we took out this little swing high. So let's consider that this is probably a wave A. Let me go ahead and label it that. Everything at this point would be a question mark, but if this is an A, then what should the market not do if it's going to make a simple ABC? So we're not forecasting, we're just looking at the market as it continues and adds bar by bar, and then we identify what it could be. Well, if we think we're making a correction, this is just a wave A of that correction, then the wave B of a simple ABC should not exceed the beginning of that wave A. Now, of course, there's many kind of corrections you're going to learn, variations even on the ABC correction, where it could exceed the beginning of the wave A. But for this module, we're just going to talk about ABC corrections. So let's add some data on and see what happens here. So I'm going to add bar by bar. Well, this advance did not exceed the beginning of wave A, and the market turned around then and declined to a new low to beyond the wave A extreme. So part of the guidelines for an ABC is that the wave C should exceed the extreme of wave A. So we have a potential here for this to be an A, this to be a B, and this to be a C in the making. I'll just put it down here. I don't know what's going to happen here, but at this point in time, we can say that the market is in a position to make an ABC correction. Well, what can the market do to say it's completed this wave C and probably completed the entire ABC correction? And that would be a trade beyond the extreme of the wave B signals the wave C, and the entire ABC correction is complete. Now, I don't know if it's going to do that, but I know if we, now that we've exceeded the extreme of wave A, if the market then comes up and exceeds the wave B extreme, then this is in a position to be a wave C. Okay, let's add some data. Okay, As of that point in time, the market is in a position, this market is in a position to have completed an ABC correction. Now, as you know, it can continue on in some sort of complex correction, but the point is we have the potential to have completed an ABC correction. In most cases, we go under the assumption that an ABC correction is complete. What follows the end of a correction? Well, a resumption of the trend prior to the correction to a new extreme. So that's why we want to identify the end of corrections. So I backed up the data just to the point where the decline had exceeded what we had labeled as a wave A. And what I want to bring to your attention is we learned about impulse trends, and we learned about characteristics and guidelines for a wave 1 and a wave 2, and then when a market would be in the beginnings of a wave 3. Well, the rules and guidelines are almost the same, whether it's a 1 or an A or a 2 or a B, and working on a 3 or a C. In other words, we can label this, or could label this, depending on other conditions, but I frequently do this when I'm looking at a market and I'm not convinced whether it's making a correction or in this case, an impulsive bearish trend to the downside. I can look at this as a 1 or an A. This could be a 2 or a B. And then we can, if we've made this new extreme, then we can say, well, what should the market do if it's making a wave C that it wouldn't do if it's making a wave 3? And what would confirm that it's making a wave 3 instead of a C, and that sort of thing. We ask, what can it confirm, one or the other wave counts? Well, we know that if this market were to come up, let me close this, and trade above this swing high, which was labeled a 2 or B, well, we know it can't be the beginnings of an impulsive trend down. It can't be that. It can't be a 1 and a 2 working on a 3, because it's just voided that, and it's indicated that we've had 3 sections down, and so the only thing it can be is an A or a B. Now let me back that data up a minute. Again, what was the other guideline that we had, or excuse me, rule that we had for that would void this as an impulse trend down, and where this could not be a 3 and then we would have a corrective 4? Well, that would be a close into the closing range of a wave A. So let's find out. There's the closing low of a wave A. So if we closed, and there we did just the next bar into this range, then we go, whoops, it's got to be an A and a B. It shouldn't be at least a 1 and a 2. So it should be an A and a B, and we're probably going to complete this as a wave C. So we add some more data. Of course, it's only confirmed as a wave C once we exceed the wave B high. So I just bring that to your attention, and this will come up more in later sections when we're looking at patterns from a different point of view on how we look at this, how we look at alternate type patterns as a market develops, where we look at it could be, in this case, a 1 or an A and a 2 or a B. We may be making a 3 or a C. So if it's making a 3, what should it not do? If it's making a C, what should it do? So we set up the parameters to confirm or invalidate one of the wave counts or the other. So I just wanted to bring that to your attention now, and we'll approach that a lot more in future modules. Let's take a look at another example, bar by bar. And what's important is to learn how to think as bars are added onto the chart, how to think about the potential pattern, what would confirm the pattern, and what might invalidate a pattern. So let's add it bar by bar. We'll assume that we've had a nice decline here, a nice trend down, bear trend, and we've come up in these last couple of bars. We've taken out this swing high. Let's assume that's a potential for a correction, and let's follow along bar by bar. So far, let's take a look at what we've got. We had the market came up above this little swing high, potential wave A. So let's put that on the chart. Potential A. We could always put question marks, but I'll just put then potential wave B. So what we've got labeled a wave B certainly did not exceed the beginning of the wave A. And as of the last bar of the chart, actually it's the next to the last bar of the chart, it's traded above the extreme of the wave A. So let me just put that line across there. It's only traded above it by a few ticks, but that's all it needs to have a potential A, B, C. Notice I'm saying potential. We don't know what the outcome is going to be, but it's in a position to complete a wave C. What would complete a wave C? Well, it'd be a trade beyond the extreme of wave B. In this case, it's a wave B low. We don't know if that's going to happen, but we can identify what the market can do to confirm or invalidate a particular pattern. Let's add some bars onto the chart. So what's up? It's met all of the rules, guidelines to complete an ABC correction. And it's an ABC zigzag correction. So I realize we didn't get any big push beyond the extreme of wave A, but it met the minimum criteria. It did get beyond it. So we could have an ABC. Let me put my, whoops, I got the wrong little icon there. I'm going to put the C in here. A, B, C, and then we came down, took out the extreme of the wave C. We have three distinct sections, and then the trend prior to this correction has resumed, and all in one bar. It's taken out the extreme of the wave B and actually made a new low all in that one bar. So what this shows us or tells us as of the last bar in this chart, we've completed three section ABC. It is an ABC zigzag, but it's probably a little bit more of what we'd call a flat because we just barely took out the wave A extreme, but that's here or there at this point in time. We'll look at some alternatives to the simple ABC zigzag later on in this module. But the key here is that as bars were added onto the chart, is we identified what the market can do to complete an ABC, confirm that it is an ABC, and that the higher time frame trend would continue. That is the trend prior to when the correction began. In this example, coming off of this high that we're showing, let's assume we don't have a firm opinion if this market is making a correction or if it's beginning a bearish impulse trend. So let's add bars on, and then let's take a look at what the structure is and what could confirm or invalidate whether it's making a correction or whether it's beginning an impulse trend. Once the market gives us a firm signal of what the pattern structure is and whether we're making a correction or the beginning of an impulse trend, once we get that confirmation, is that will have to do with then how we develop our trade strategies, which side of the market we trade, what will be the signals for the market to continue, that sort of thing. So let's add on bar by bar and see what decisions we can make based on what the market is telling us by its pattern structure. So let's just take a look at it, what we got so far. We have a decline, and then we have some sort of correction going on here. At least that's what it appears to be. If we should come down and take out this swing low, we would have what we call a 1 or A or a 2 or B. And then we'd want to take a look at the data as we get more bars under the data for what would be the confirmation. It's either a 1 and a 2 or an A and a B. Okay, let's add some more bars. There we go. Big decline here in these last couple of bars. So what do we have so far? We have a decline, some sort of correction, and then a continuation of the decline. So are we making an A, B, C correction? Or could this be a 1 and a 2 and a 3 of an impulse trend, like you learned in the last chapter? Well, let's not make that judgment yet. Let's put a 1 or an A, a 2 or a B. Now, what could the market do to, let's say, invalidate this as a probable 1, 2, and this being a 3? So if this is in wave 3, what can a wave 4 not do? Well, not close into the closing range of the wave 1. So I'm just going to do put a horizontal line from the close into the closing range of this potential wave 1 or A. And if the market turned around and advanced and closed above 25.14, that would be an overlap, and it would indicate more than likely this was not an impulse trend. More than likely it's a correction. And when the correction is complete, the trend prior to the correction, which in this case would have been a bull trend, will continue to a new extreme. So let's just continue to add data and see what we come up with. Hit that a little bit too fast. Let me just take one bar off. There we go. Oh boy, what a big up bar this was. Well, traded well into, closed into the range of this decline. So it should not be a 1 or a 2. It should be an A and a B. We haven't confirmed that it's a wave C, because what confirms a wave C? Well, it's taking out the extreme of wave B. So let's just put a line across that. It'd be taking out the 25.34.345 high up here. That would confirm it's a wave C. But at this point in time, with the overlap, closing overlap and trading overlap both, more than likely this is a A and a B and a C. So do we want to wait until we take out this high? Well, that's the confirmation for sure. If we continued to advance and took out that swing high, that would confirm this as an A, B, C. It would confirm this decline as a correction. And as you'll see in future sections, is that it's not necessarily the end of a correction, because a correction can take a more complex sort of form, but it would confirm that it was at least some sort of correction, and probably a completed ABC, which should be followed by a continuation of the trend prior to the ABC, and that was the bull trend to a new extreme. So we have some really valuable pieces of information as of the last bar in this chart, is that more than likely we've got an ABC. So what I usually do, until a particular wave count or section is confirmed, I just put a question mark on it. So let's just add some more data and see what happens. Well, yeah, we kind of know what happens because I had put that bar on earlier, but we had another big up bar. We took out the extreme of the wave B. So it has confirmed that it's an ABC, and a few bars back it confirmed that it was not a 1, 2, and working on a 3. So this is quite a bit after this one bar, because it's such a wide range, it's quite a bit above the extreme of the wave B. So we don't have to buy the low and sell the high. We just have to recognize what's the direction of the trend, so that then we can develop our specific trade strategies, including the entry strategy and the protective stop. Because depending on some of our other technical analysis and the higher time frame pattern, including the higher time frame pattern analysis, this trend may have a long ways to go, and this is just the beginnings of the next section of a bull trend to a new extreme. Could be quite extreme. Look how big this section was. Now, I don't know if it's going to be anything like that, but the point is we have confirmed that this is a corrective decline, and the bull trend should continue to a new extreme, and that's a valuable piece of information to have. Let's take another look at another example. This example is the XLK. It's an ETF stock for the tech sector. Everything we teach, as I've mentioned before, is applicable to any actively traded market in any time frame, whether it's stocks or ETFs or futures or Forex. So here we have a significant decline, and I've labeled it a wave A, but I've got a question mark on it because we don't know yet whether it's an A or one on a bear trend on the downside. It would depend a lot on what happened before this decline began. But we're trying to keep it pretty simple and see how we identify a potential correction and what would confirm that that correction is complete, or what would invalidate it as a corrective decline and indicate that it's in a bear trend. So let's just look at this decline. This is an interesting example because I'm going to show you the closing data here. So the closing data, the low close, let me mark that off. The low close is on that bar, but the intraday low is this really wide range bar that happened about 2 days before the low close. So which is the low of the wave A or potential wave A? Is it this bar and on this bar? I really like closes on daily data when we take out swing high closes, swing low closes. I feel they're more important than even the intraday. So we certainly should look at the intraday, but the strongest signal on the daily data is going to be on the closes. What I'm going to do here, I'm going to revert just to closing data. And I'm going to take this out because we're going to focus on the closing data here. So let's mark off this low on the closing data. So here we've had a decline, then we've had a pretty strong rally, and we've come up to test or actually slightly exceed the last little swing high. So we're going to look at this as a potential wave A. I'm going to put the question mark there because we really don't know. And you know what I'll do? Why don't we look at this as a 1 or A? There we go. And whenever we finish this advance, that would be a 2 or B. So let's add some data on here. And there we go. We've already closed below the 1 or A. So let's look at this as a 2 or B. Well, let's add some more data on here and then see if we have some information that can help us make a decision. Another decline, pretty sharp decline. Now we had a... So again, we're looking at this as if it's we're making a wave C or a wave 3. So what would avoid it as a wave 3? A close above the swing low close. That would be a closing overlap, and more than likely this is not a wave 3. More than likely it's a wave C. It's at least in a position to be a wave C, and of course it would take a close above this extreme. So we don't know what's going to happen, but we've identified what the market can do to indicate what is the position of the market, whether this is a bear trend or making a correction. So let's add some data on here. There we go. As of the next bar on the closing data, next day on the close, we closed up into the range of what we were anticipating is a 1 or an A. So if that's the case, then more than likely this is an A, we made a B, and more than likely this is a C. We could put question marks on all of these because it's not confirmed as an A, B, C until we close above the extreme of what I got labeled the wave B. But this gives us our initial warning, let's call it, because it's a closing overlap, that this is probably a corrective decline and not an impulsive decline. So let's add some data. We're closing even further into the range of the closing of wave A. So continue to add some data, kind of going sideways. So we can be pretty sure at this point in time that this is an A, B, C. It's certainly not a 1, 2, 3. That's for sure. So again, let's just add data. We came back down in there. Does this void it just because we came down below that? No, we've had the overlap. So let's just keep adding some data here. Sideways, sideways, and then finally we continued up. So this is a really good example of how we go bar by bar. In this case, we're just looking at the closing data, probable A, B, C. It didn't immediately begin a big bull trend. We came up several days, closing into the closing range of the initial decline, what I labeled a wave A, bounced around quite a bit. In fact, this is very much like a correction itself, little impulse up, little correction, and then we finally took off to a new extreme. And we can add some more data. What happens when a correction is complete? The trend prior to the correction continues to a new extreme, and that's what's happened. So again, we look at this bar by bar, and we decide at particular points of time what the market can do to confirm or invalidate a correction or a trend. Well, this is the British pound versus the dollar Forex data, and it's 240-minute data. In other words, there's a bar every 240 minutes or every 4 hours. So let's take a look at this data and once again look and see how we confirm if it's completed an ABC correction and what the follow-through ought to be. So coming off of this low, we've got a pretty nice potential A, B, and C. Again, I could have all of these with question marks, but let's just assume that we believe that we're making a correction, that the higher time frame trend is bearish, and we want to identify when the correction is complete, or I should say, when it's in a position to have completed a correction, so we can develop a specific trade strategy. In this case, it would be to get short or to be bearish. So let's add some data on to this chart. And first, what we got to do, of course, is we got to draw our line. Remember, closes are really not relevant on intraday data. So here we are, we added a bar onto this data, and we came and traded well into the range of what I've got labeled a wave A. That's our overlap. That is a warning, at least, that this is a correction and it's in a position to be complete. Of course, we don't have a confirmation that it's complete until we take out this wave decline below, I should say, this wave B low. But let's talk about a little bit about trade strategies, which of course we have a whole section in the course about. There would be other factors that would be contingent on what trade strategy we used, but potentially by having this overlap, declining into what I got labeled the wave A, we might immediately consider specific go short trade strategies. It would depend on some other factors, but we want to be aware of that. And certainly once we got below the swing low that I've got labeled as a wave B, then we'd only want to consider go short or bearish trade strategies. So let me just add some more bars on this chart and see how we unfold here. We continuing lower after we made this overlap. We don't always, of course, continue directly lower, follow through on the downside, but sometimes we do. And let me add some more bars. And there we go. As of the last bar on the chart, we've just had this very consistent, what we'd call an impulsive bearish trend to trade below what I got labeled the wave B extreme, which would typically be our confirmation that an ABC correction is complete. What follows the ABC correction? Resumption of the trend prior to the correction, in this case, the bear trend. And how far and how long in time it's going to go will depend on some other factors, but usually it's a great position then to consider, in this case, short or bear trades. And if nothing else, it warns us it's probably not a time to consider long trades, because this is a confirmation of the continuation of a bear trend. So we can actually erase that question mark. And let's add some more data onto the chart, see how things worked out here. Before we add more bars, there's our swing low, which was the beginning of the correction, and looks like we traded below it just by a pip there. Keep adding some bars on here, anticipating that we've completed an ABC correction and the bear trend is going to continue, but whoops, it didn't. So I wanted to use this example to show you no matter how perfect a wave structure might be, is there's not necessarily going to follow through as anticipated. And of course, in this case, it didn't follow through at all. This one little trade by 1 pip or something below this low is kind of irrelevant. We came down, we made the confirmation signal by trading below this wave below after just an idealized 3-section advance here, which would be just a great setup typically for continuation of the bear trend, but that's not what happened. So that's why we have trade strategies. And of course, at the very least, our stop would be where? Well, it would be at the point which invalidated the continuation of the bear trend above this high if we happen to be short this market. So these structures, when they get confirmed as probably having completed one structure or another, we always know that where our stop is going to be at the extreme anyway, and that's where the structure was complete. Now, would the stop have been placed somewhere else? It depends on the trade strategies. More than likely, it would have been placed closer to the market following this decline, and more than likely, because there was so much distance between this high and where we took out this wave below, that wouldn't have been an immediate go short strategy because there's so much distance here. And so the stop would have probably been too far from the entry, and we would have looked for another opportunity to go short for the continuation of the bear trend. So that's what we'll talk about a lot in trade strategies later on in the course. But the lesson here is that no matter how perfect a structure appears to be, no matter whether it's made a really high probability confirmation that that wave structure, that pattern is complete, and sometimes market just turns around and doesn't follow through on the potential completion of that pattern, just as it did in this case, and something else is going on. So that's why the lesson that we learn over and over and over again is identify the probable position of the market and then identify the trade strategy that allows you to enter the market with acceptable capital exposure. While the ABC zigzag correction is the most common type of ABC correction, any correction that's 3 sections can be an ABC, not necessarily a zigzag or following the rules and guidelines of a zigzag. There's lots of ABC variations. However, most of them are unusual. They don't happen very often. But the ABC flat is probably the most common variation. There's also expanding and contracting ABCs, irregular ABCs, but with all of these, the common characteristics are each follows an impulsive trend, a 5-wave impulse. Each fulfills the minimum 3 sections for a counter trend, 3 identifiable distinct sections, and each section subdivides the same as an ABC zigzag, as you'll learn in the subdivision section of the course. Let's just take a look at 2 or 3 examples. Most of the unusual examples, like expanding and contracting ABCs, irregular ABCs, are so unusual that I had a hard time even finding examples, even going through lots of markets and lots of different time frames. So I'm only going to show you a few examples on what to look for, and maybe as we go through the course, if we come upon some other irregular type ABCs, we'll know how to identify them just by simply the market action following a 5-wave impulse trend and it forming at least 3 sections. So let's take a look at this first example, and it's gold 240-minute data. We had a 5-wave decline, and then we had a essentially sideways, but we had really well-defined distinct advance and then a correction, and then another advance that basically was a double top with this first high, and then a correction down. We have 3 distinct sections, which has the possibility of completing. Basically, we call this an ABC flat correction. It's where the wave C doesn't exceed the extreme of wave A, like is typical with a simple ABC zigzag. So we know that we've had 3 distinct sections. We'll have other tools later on you'll learn to identify if this final section may or may not be complete, but certainly if it traded below what I got labeled as the wave below, it would be complete. It would have broken the pattern. So let's just add some data. For instance, as of the last bar in this chart, this market is in a position to have completed an ABC flat. So again, it is a correction following a 5-wave trend. It had a minimum of 3 sections, 3 distinct sections. And when the last section was complete, and that would be signaled that it's complete, a pattern reversal signal, having taken out what I got labeled as the wave below, more than likely an ABC flat correction is complete. Now, we don't have the benefit of the overlap rule when we have a flat correction, because the wave C, at least we should say the potential wave C, has not exceeded the extreme of the wave A, at least not more than, in this case, just on this 240-minute bar by a little bit, to which we can then engage the overlap, closing overlap rule on the daily data. So we had to wait until it took out, in this case, the wave below to indicate that this ABC flat was complete. Let's take a look at another example. Here's crude daily data, and again, substantially the same thing. We have a decline, and then we have a distinct section up, another decline, basically makes a bottom right around where this first low is after this decline. Then we have another advance, again, makes a top right around this high. So we've got a potential 1, 2, 3 sections against the, we're assuming that the higher time frame trend is bearish here. 3 sections, it has the potential for being what we call an ABC flat correction. Again, we don't have the benefit of the overlap rule to give us an earlier signal that it's complete, but once we trade below the potential wave below, that's a signal that an ABC flat correction is complete and the bear trend should continue. We usually say when a correction is complete, the trend should continue to a new extreme. Well, because it was a flat, by taking out the wave below, we're just a little bit of ways away from the prior trend low, but we'd have to look at our other pattern positions and our other time and price positions to see if we're anticipating the trend is going to continue for a substantial amount. the important factor is we identified a possible, or I should say a probable, ABC flat correction by the 3 distinct sections, and then we took out this swing low. Here's the ES daily data. And again, we had a real substantial bull trend coming into this high. I'm only showing the last few bars. And then a decline for a possible A. Now, I've already labeled this an irregular ABC to complete the wave B. We might have been looking at this as an A and a B and a C as if it potentially had completed an ABC correction. We had a big up day, but then it turned right around and made a new low. What's important here is we identified that this is a corrective pattern, that this is probably an A, and then this is an irregular ABC to complete the wave B. And then once we made the new low, we're in a position to have completed an A, irregular B, and a C, and then we came and closed up into the range of what I got labeled a swing low, the wave B of B low. We'll talk more about subdivisions later, but it indicated that this ABC correction was complete and the wave B itself was an irregular ABC. So those are just a few examples of a few variations on an ABC. Like I say, the types of expanding and contracting ABCs and the irregular ABCs are very uncommon. But what's important is to recognize they will have the same characteristics as a typical ABC simple zigzag. They'll have common characteristics in that they will follow an impulse trend. And so it will be important to identify when that impulse trend is complete. And then they'll fulfill the minimum 3 sections for a counter trend. So that's what we'll be looking for. And we'll probably come across some irregular and unusual ABC types of corrections in our examples throughout this course. Just wanted you to be aware that not all ABCs are simple zigzags.